With stocks closing at a strong November here, should investors expect another month of gains? For more, let's welcome in Ryan Dietrich, Carson Group Chief Market Strategist. Always good to see you, my friend, have you on the show. How about a history lesson to start here, Ryan? You know, what does December teach us historically about the market? What do traders and investors need to know?
Yeah, thanks for having me back, first off. I mean, listen, I know I joined you guys probably about a month ago. We talked about why November is usually pretty strong. Well, that played out with the best month of the year. Then you talk about December. No month, on average, is up more likely than the month of December. It's up like 74% of the time. In an election year, no month is up more likely, up about 83 or 84% of the time. Here's what's really interesting. If you go back the last 10 elections, so about 40 years, December's been higher for the S&P 9 out of the last 10 times. When you're up 20% for the year going into the last month of the year, like we were this time. And again, this was actually, I believe it called your chart of the day in your briefing note this morning email. So thank you for adding me there. When you're up 20%, the last 10 times, December's been higher, 9 of them. All right, so I just threw a lot of numbers out. I get it. The reality is we've been bullish. We think there's still a little bit more to go, and December is probably going to be a pretty solid month, guys.
Now is where I insert that time-honored disclaimer: past performance is no guarantee of future results. Yep. But I am curious, when people have a year like this, what kind of end-of-year positioning do we tend to see? You know, because people don't want to, if you've even matched the market's gains this year, let alone outperformed, you don't want to do anything to mess that up in December, right? So how does that kind of play out as the month goes on?
Well, great question there. You know, right before the election, let's kind of combine these 2 months, really. I mean, what did we see, right? We saw a lot of puts coming in. We saw a lot of hedging. We saw the VIX higher. And we said, listen, when the election's over, the uncertainty's alleviated. It doesn't really matter who wins. We expected to see an upward bias. And that's what happened. And I'll tell you, I do this for a living, right? Talk to a lot of people. The honest truth, a lot of big institutional money managers have missed a lot of this rally. They've been even weight. They've been underweight, overweight bonds. And it's cliche to say, I get it, cash on the sidelines, but it's one thing we've expected. And again, at the end of the year, that's why I think you tend to see this upward bias. There's not a lot of news normally in December. Now this one, hey, we do have a Fed meeting. Will they or won't they cut? We've got a couple things to think about, but the reality is you tend to see a chase in strong years. And we just think that's the case. And still, with a lot of money managers underperforming overall, that's why we think that'll still happen.
And Ryan, listen, you've been overweight equities, I think, since December 2022. You remain overweight here. So beyond December, though, looking further out at 2025, why remain constructive, Ryan? What are the reasons?
Yeah, great question there. So 2 years ago right now, Carson Group went overweight equities. If you think back to that time, it wasn't very popular. People were not happy for whatever reason. Weren't happy with that call. We didn't think there'd be a recession, thought stocks would do well. Now we're up over 60 some odd percent, over the last 2 years. What's going to happen next year? Well, we still think we have a dovish Fed, right? We still are looking at record earnings. We're still looking at the strongest profit margins this cycle. Yes, the third year of a new bull market tends to be a little bit choppier. So that's one thing that kind of can restrain us a little bit here. But I love that right before I came on, you guys talked about market breadth. And I know I've come on for a while saying expect more participation. That's what we've been seeing. 2 weeks ago, 10 out of 11 groups outperformed the S&P. Last week, 8 out of 11 groups outperformed the S&P 500. We've got small cap leadership. We've got mid cap leadership. We think next year a big theme again is that overall a lot of participation. We've been neutral tech all year. People didn't like that earlier in the year, but now it's not like we hate tech. Neutral, people hear neutral. Oh, that means they're bearish. No, we've got a lot of tech exposure in the money we run. We just aren't going overweight because again, there are some valuation issues. There are potentially a lot of high bar when it comes to technology. So we just think some of these other areas look really, really good, specifically small and mid and those cyclical areas, which have been leading, really the second half of this year.
And Ryan, that's a really good reminder for people, by the way. When you say neutral, it means you hold it the same way to the market. You're not necessarily buying, not necessarily selling to get that all out of whack. What could go wrong with all of this? What's the biggest risk right now?
Yeah, I'll tell you, I guess I'll go with two. Valuations are stretched. Now, honestly, 12 months ago, people were talking about valuation stretch. That just means the bar is a little higher. But the one that gets me more than anything, the strength in the U.S. dollar. Normally when the dollar's strong, kind of a risk-off scenario. We've got a strong dollar since the election. Now, I'll tell you what, I think a lot of people are talking about this stronger dollar. A lot of people are talking about higher yields. That inner contrarian in me thinks those are going to come back down. But if the U.S. dollar continues to strengthen, that could kind of upset the apple cart. And look at what happened just the last 2 weeks, right? International markets haven't done very well because dollar's been strong. U.S. markets done just fine. I'm honestly surprised how strong U.S. markets have done with the dollar strength we've seen. But the dollar continues to be pretty strong here. That could be one thing here that can upset the apple cart, as they say.
And Ryan, how are you thinking about the incoming Trump administration as a strategist? Taxes, deregulation, tariffs. I'm guessing you're getting questions about it.
Yeah, we get those questions. And honest to goodness, we don't put a ton of emphasis on it. Now, I'll be aware we've liked small caps. We've liked mid caps. Yes, you've got lower taxes. You've got an economy that's strengthening. Look at just today's data. It doesn't do with President Trump coming in. Stronger construction. Manufacturing is likely bottoming. I mean, the underlying economy continues to be strong here. And I'm a creature of habit. I look at what happened, when Trump was in office last time. The market did okay last I checked. Obviously, the market's done just fine under President Biden as well. So the bottom line is don't get too worked up over these things, is what we say. Everyone said before with President Trump, a lot of people talk about this, which groups would do well. The exact opposite happens. So don't just think it's always so obvious. But the reality, again, is he's put some people in play. I know some of the more extreme people he's put out there. I don't want to go that way. But look at the Treasury Secretary, right? I mean, that's kind of right down the middle. People like that. I think he understands his scorecard is the market. I mean, that's one thing we know about President Trump. His scorecard is the stock market, and he's picking some, we think some pretty good people that can be on that side of the keeping the market and the bull market honestly afloat.
And as you say, he has an interest in keeping it up there since he does see it as a referendum on his performance. Thanks a lot, Ryan. Great to see you as always.
Thank you, guys. Appreciate it.